Hello and welcome to the newsletter. Can you believe 3 months is gone? It seemed like yesterday that we started 2025, and today for the first time, Owen. Welcome, Owen. Welcome to joining us on this monthly update. Just firstly, Owen, a bit about background about yourself.
Hi, Theo. Yeah, thank you. So I'm a financial planner here in KZN. I joined Galileo a year and a half ago now. Can you believe it? And basically, I've been running and helping servicing the KZN clients. I'm from KZN myself. I was born here. I grew up here, and was schooled here. And only after school did I head down to Stellenbosch University, where I studied a BCom honors in financial analysis, and then later went to the Stellenbosch Business School and completed my CFP. And since then I've worked in Durban, and like I said, a year and a half ago joined Galileo, and I've been very happy here. I live in the Midlands, and have a wife and two kids, Haley and Ollie, who are now 3 years old and 5 months old. So things have been busy at home.
Wonderful, wonderful, wonderful. And I think you've been a great contribution and a great asset to the team. So yeah, from our side, Owen, welcome, and I hope you enjoy your first discussion with the on this platform.
Thanks, Theo.
So if I look at just a bit of background on what's currently driving financial markets, and probably the biggest news that we are going to live with for the next few months is, on the one hand, the America and Trump, what it will do not only to alliances but to South Africa from an economic point of view, from a policy point of view, from a tariff point of view, and then on the other side of the coin, if you talk on that respect, the government of national unity. So let's just get back to the whole tariff issue around Donald Trump, and the fact that, unfortunately, currently South Africa's formal negotiation position or platform with the United States is not on a great footing. The US doesn't have an ambassador in South Africa. You have to remember that last time around, Donald Trump only appointed the ambassador about 2.5 years into his 4-year term, but we do not have an American ambassador. And also, the turmoil around our ambassador, Mr. Rasool, currently we're also in limbo. So it's not at the great place. That means there's a very difficult in formalizing flows of communication, flows of delegation, or communication between the two countries. One have to realize that if a formal government delegation goes to the US, it's via formal diplomatic channels. That means it's arranged by the different diplomats in the different countries, by the ambassadors, by the different desks, and we're currently in a position where that is not there. So it makes it very difficult for our government to directly engage with the US government. That's, I think, the first point we have to appreciate. The second point is we cannot make any recommendation or asset allocation or investment decision based on our ability to guess where that's going to end. We cannot predict how this is going to play out. So therefore, instead of predicting, we should rather focus on things like diversification. Make sure you focus and manage on the things you can manage, but it's very difficult to predict and to say where it's going to go. And I think perhaps Henry Kissinger, which is probably at some point was the American Secretary of State, and probably one of the most seasoned and successful, most quarters viewed, successful diplomats the world has seen. He at one point said that to be America's enemy is dangerous. To be America's friend is fatal. And I think that is where countries like Canada came to realize, the European Union came to realize. And I think if you want to understand America and the Trump administration, just go to the website of the State Department. That's the Department of Foreign Affairs. And there's a document by Marco Rubio, the Secretary of State, which states very easy, very focused on how America's foreign policy will be governed, how every single dollar will be spent, how every single policy will be structured, and everything will be measured on three basic tests. Does it make America stronger? Does it make America safer? And does it make America more wealthy? And I think those are the 3 points. Does it make America more prosperous? Those are the 3 points that you have to keep in mind. And there's no other comments around how or what and where to leave other countries, bar for the fact that he's focused on making America stronger, making America more prosperous, and making America safer. So that's the one side. What we have seen in financial markets, specifically the last month or so, is the big American indices have come off quite a bit. And depending which index or which stock you're looking at, I mean, since the beginning of the year, a stock like Tesla has almost halved, but it's still up year on year. The Magnificent Seven we talked about, most of them is down 18 odd percent in the last few weeks, few months. So there has been a shift. There's also been a shift out of US equities into the rest of the world equities. But I think to try to predict how this is going to play out is going to be extremely dangerous and is not what one should be looking at. The second point is South Africa. Where is our government of national unity heading towards? And I think there's just 2 points I'd like to make on that. Number one, I think the big three parties in the government of national unity, or specifically the big two parties, the ANC and the DA, realizes they need one another, and they realize that both of them have to make this work. But that also creates brinkmanship from both sides because they know they have to be together. That's the one point. The second point is, I think we've now seen that the red line in the government of national unity is actually the Constitution. And almost all difficult legislative acts would be tested in the Constitution. And that will be measured by how it stands up in the against the Constitution by the Constitutional Court. I think that will be the point of departure. However, I do think we're going to see this kind of difficulty in getting things done more often than not. And I think that's part and parcel of growing a democracy. And I also tend to think that we'll have to get used to a bit of brinkmanship in government. What it also results is most likely, and I think it's a big lesson to all the parties, no party can purely make ideological decisions. In the past, even in the Zuma era, the Minister of Finance could present a budget and there was no question that was the budget. I think that's past. Budgets will be debated, there will be views put across, and there will be different outcomes. But I think that is kind of where we are. And that brings one to the fact, Owen and I, of the fact of risk and the fact that one needs to look carefully at what you understand as risk is from an individual investor and how you mitigate or manage that risk. And I'd like your input on that.
Thanks, Theo. Yeah, so the current backdrop that we're facing, and as you've painted, is a picture of volatility, potential volatility. And if we just break it down break risk into three parts. One being volatility, and that's basically the roller coaster ride that equity and investors who have a fair percentage of equity in their portfolios are subject to. And the second is the risk of permanent capital loss. That's a more devastating risk of an example would be a standoff. An investor will never recover that loss. And then lastly, inflation risk, which is almost a silent risk. A lot of the time, where you in a portfolio that's sitting in cash and being eroded by inflation, you may only feel those effects and after 10 years, where you look at your portfolio and you think, wow, this is not the same, doesn't have the same purchasing power that it had 10 years ago. So if we just look at those and discuss that more, I think what a lot of investors focus on is volatility. And that is an inevitable part of being a long-term investor. We need to invest in shares to outperform over the long term. And volatility is a byproduct, and we need to accept that. Unfortunately, a lot of investors' focus is fixated on that volatility. And I think the two other main risks are the ones that actually can have a detrimental impact on your portfolio. Something like selling out at a market dip because of the uncomfortable feeling that that volatility gives you, that's a permanent loss of capital that's triggered. Another one would be sitting in cash because you afraid to make a move into a market where the feeling of certainty is more comforting than the decision to go into a growth portfolio that's going to provide you the benefit over the long term. You'd rather sit in the certainty of the short term. So just going back to the environment you've painted, both locally and abroad. How do we manage those risks?
Look, if you take back, and I just want to talk about, I would elaborate a bit on those three risks, because you stated it very nicely, and I think we need to be aware that, first of all, volatility, because you have to have growth assets in the portfolio to outperform inflation. Growth assets, unfortunately, does not go up in a straight line. Markets is volatile. Markets has got sentiment. Sometimes markets will overreact. They will underreact. Sometimes markets will be shocked. Will price something different in. So you will have volatility if you need growth assets in a long-term portfolio. And that means you have to make peace with the fact. And then just to put it into perspective, it is not uncommon for equity markets to lose 10, 20% every year, every second year, and even bigger amounts at some point in future. The problem is you cannot forecast those. And that's the problem with it. You don't know when it's going to happen. But having said that, that's where you get the long-term real growth from. So that is volatility, and it is a natural phenomenon in financial markets. And I can predict that at some point in time, the market will again probably lose 10, 15, 20, even more percent. I just don't know when. But it will happen at some point in future again. That's the nature of financial markets. The point, however, is to make sure that the structure of your portfolio is balanced in such a way that you don't have that full volatility, and that doesn't result you in having to sell to make it permanent loss of capital. If you then go to the other two, now just a point on having a portfolio with volatility. If your portfolio outperforms, let's say the money market, 7 or 8%, let's say you get more than 7 or 8%, and there's no volatility, you're most likely in a scam. And that is where people get caught. They believe you can earn more than that without the volatility. So if you are being sold something that will provide 10, 12, 13, 14% growth per annum, and there's no volatility, that's usually a scam. So in order to get more than, let's say, 7 or 8%, you have to take risk. That risk comes from volatility in the short term. In the long term, however, statistics and analysis shows you that you will get the performance above inflation. That's the one thing. The second point is then the loss of permanent capital. Now, that could be a Steinhoff. Warren Buffett at some point explained it very nicely when he said it's almost like the Russian roulette risk. You don't want to take that. Russian roulette means it usually goes in your favor, but when it goes wrong, it's horribly wrong. You can't be in that risk. So you can't take that 1 in 6 chance of you hitting the wrong bullet. That's not how you manage and mitigate risk. Again, the answer is to diversify asset classes, diversify jurisdictions, and diversify even the time that you buy into the market. So that's diversification. And that's a loss of permanent capital. But the silent killer, the enemy, is inflation. Over and over, that means $100 today cannot buy the same set of lifestyle, same set of cappuccinos, or same set of stuff in 10 or 20 years. So therefore, you have to come all the way back and you have to say, but if I want to preserve my capital in purchasing power terms against the risk of inflation, I need growth assets. I need something that performs more or at a higher yield than inflation. And that's where the balance comes in. So the key element, and I know it's the old saying, your only free lunch is diversification. And that is what it comes down to. A properly diversified portfolio, different asset classes, different jurisdictions, different factors having performance at different times. And remember now, a good diversified portfolio will have things going up and things not going up, things going up more and things going down. That's diversification. It actually means all your assets is not going to go in a straight line. There's going to be a difference. But I want to bring the conversation, Owen, back to another point. A question, and perhaps that is part of the advice. If you look at that pension fund, provident fund versus an RA, just talk about a bit about your view on how one should approach it, specifically if you're in the building phase.
Thanks. Yeah, it's been a topic that's come up about in quite a few of my meetings with clients lately, and those are largely in the accumulation phase. And the question is, how much should I be putting towards my pension fund, my provident fund, or my retirement annuity? There's a great tax incentive for your contributions. Should I not be putting all my money into this type of product? And on the other end, I have a few clients who have saved throughout their careers and now are sitting in a position where they are 90%, some of them 100% of their savings are in a living annuity or a life annuity, which is the product that you essentially transfer your pension or your provident or your retirement annuity over to when you retire. And the issues that they are facing now are flexibility. They are only able to, they basically have a set income that has to fund all their financial needs. So a new purchase of a vehicle, which is a big capital outflow, can only be funded from a monthly income now. And so there's definitely a need for a balance. I think when you're accumulating capital for retirement, it's very important to build both a discretionary pocket and a compulsory pocket. Compulsory is a jargon for your retirement funds, your pension, your provident, your RA, and discretionary being a direct unit trust or an ETF. And basically building that discretionary bucket creates a far greater flexibility in retirement to be able to fund unforeseen expenses, medical costs, car bills, and in addition, also being more tax efficient when you're drawing your retirement income. And there's not a rule of thumb that you must build with 50% in discretionary or compulsory. It will go case by case, but it's definitely something for someone in the accumulation phase to be aware of, is that there is a need for flexibility in retirement, and it's something to be planned for.
Yeah, and I think sometimes people underestimate the fact that the planning part in accumulation, what the effect on that is in the end when you live off your capital. And I wanted to just add another factor to it. Remember, tax planning is as important in the accumulation phase as it's in the phase when you're withdrawing income. And again, it depends on the various sources of where the funds are invested, can have a big impact on that. So just as much as you take care when you invest and when you prioritize to build up your investments in terms of tax and liquidity, just as much should be taken when you're in the phase of withdrawing, both from a tax and from a liquidity point of view. But I think the end is, Owen, and I think you said it very nicely. There is absolutely no rule of thumb. There is, for every single situation is different. Every person has got different needs, but that needs to be matched according to him or her financial goals or what they want to achieve and what money is for them in their lives. But I think you're dead right. These things all needs to be accumulated, all needs to be taken into consideration if you are in the accumulation phase. And I think that is the key most important thing. Can you believe it? 3 months of the year is gone. Thank you very much for your contribution, Owen. And I look forward to talking to you in some of these discussions in the rest of the year. Thank you very much. All the best.